Hello everyone. In some cases, distance cannot make us immune. And this is the case in bond markets, as Australia is currently demonstrating. Australian sovereign bond prices have been falling for several sessions, led with the belief that the current monetary policy tightening will be the most aggressive since the 80s. The yield on the 3-year government bond ended the May 4 session up 14 basis points at 3.15. Its highest since 2013, and the yield on the 10-year bond climbed by 5 basis points to 3.55. That's the highest since 2014. The sell-off continues to be fueled by the RBA, which raised its key interest rates by 25 basis points on May 3rd, with a steeper than expected increase, and furthermore, the comments clearly signal further tightening. In essence, it is time to scale back the extraordinary support measures implemented over the past 2 years. It stressed that inflationary pressures and near full employment no longer justify historically low rates. Thus, the RBA, until recently classified as a dove central bank, has now joined the hawk clan. The market reacted by drastically revising its monetary policy expectations. Interest rate futures point to an additional 2.8% increase this year, and if the full move was to materialize, it would be the most pronounced tightening in a single year since 1989. According to Bloomberg, this scenario would imply an increase in the policy rate in each of the 7 meetings between now and the end of the year, including 3 above the traditional 25 basis points increase. Some major houses are banking on an RBA that would hit hard and fast in order to convince markets that the fight against inflation is under control. This is the case of Goldman Sachs, for example, which is now counting on 50 basis points hikes in June and July, as well as on a key rate at 260 at the end of the year. Correct or not, these forecasts are in strong contrast to the median projection of 1% on a Bloomberg survey on April 21. They represent the market's response to the RBA's admission that a rate hike is inevitable given the strong economic recovery from the pandemic. This change has, of course, an air of déjà vu about it, and thus brings the RBA closer to the vast majority of its peers. The wave of global tightening, including potentially hundreds of billions of dollars of central bank balance sheet reductions already this year, has weighed heavily on bond markets. This week, German 10-year yields climbed above 1% for the first time since 2015, and US Treasury of similar maturity rose above 3% for the first time since 2018. So the wave is now reaching Australia, showing us that no man is an island. Thank you.